Hi, my name's Eric, and I'll be reading you selections from Barrons magazine for Monday, March 4th of 2025. This reading is produced by the Audible Local Ledger, a reading service for people who are blind or print disabled. We'll start with up and down Wall Street. Rotation to sell-off? The stock market's at a tipping point. When does a rotation become a sell-off? Investors may soon find out. For many investors, 2025 has been about switching from winners to losers, from the Magnificent Seven to select members of the other 493 stocks in the S&P 500 index, from growth to value, and from U.S. to international. So while the S&P 500 has given back much of its gains for the year, and the Nasdaq Composite has sunk into the red, the Dow Jones Industrial Average, everyone's favorite laggard, has been staying afloat with a 3% gain. Growth stocks have gotten hit. The Russell 1000 Growth Index has dropped 1.8%, but the Russell 1000 Value Index has gained 4.7%. This kind of rotation doesn't have to be scary. In fact, it's often what keeps rallies going. It's one reason the S&P 500 is up a touch this year, even though the Roundhill Magnificent Seven exchange-traded fund has slumped 4.5%. Rotation, quote-unquote, has historically been labeled as the lifeblood of a bull market, writes Craig Johnson, chief market technician at Piper Sandler. We believe now is not the time to worry, but rather to focus on emerging leadership in other sectors demonstrating relative strength. The culprit this time around might be a beta reversion, according to Renaissance Macro Research's Kevin Dempster. In market terms, beta is a statistical measure of a stock's volatility relative to an index. When stocks with high betas, think NVIDIA and supermicrocomputer, are outperforming, it signals risk on. But the trade got too strong, with the most volatile stocks relative to the least nearing their highest outperformance on record in December. That has since reversed, and high beta is now underperforming by nearly as massive an extent. While some would attribute this unwinding to economic factors, Dempster notes that corporate and high-yield bonds would be getting hit, as would financial stocks. Bonds are holding steady and financials are rallying globally. Earnings suggest that Dempster's on to something. For much of the past 2 years, a small portion of the market had a monopoly on earnings growth, resulting in the outperformance of the Mag 7 and other high-flying tech companies at the expense of everything else. That's starting to change, notes Tavis McCourt, Managing Director of Institutional Equity Strategy at Raymond James. Tech sector earnings per share are expected to spike 23% in 2025, unchanged from 2024. The remaining 10 sectors should see accelerating growth, with consumer staples, materials, energy, and communication services flipping from declines to gains. The story of fourth quarter earnings in 2025 guidance season has been that year-over-year EPS growth is starting to finally broaden out across the U.S. and the world, and this appears to be driving a broadening performance across global equities, McCourt writes. But sometimes rotations can go too far, and the stock market is nearing the tipping point. One way to gauge whether the market's about to become more dangerous is by looking at the correlation among stocks, says John Kolovos, head of technical strategy at Macro Risk Advisors. When correlation's low and individual stocks are moving on their own accord, it's usually a sign that a rotation is happening. When they start to trade in tandem, it typically means investors have stopped looking for idiosyncratic opportunities in favor of trading everything together. Recently, the CBOE Implied Correlation Index, which is a measure of correlation based on options trading, rose as high as 20.6, up from 12.1 on February 20th. Both levels are still low, and a correlation in the 20s isn't all that unusual. The index had 4 previous spikes to that level over the past 12 months, and the S&P 500 dropped an average of 3.8% when they occurred, not much less than the 4.6% decline the S&P 500 suffered through its peak through Thursday's close. Even an August spike to 35.7 resulted in a decline of only 6.1% before the bull market resumed its climb. It was only when the correlation index surged above 50 and stayed there in 2022 that a bear market kicked in. We're not there yet, and perhaps never will be. That doesn't mean stocks can't fall farther, but even that might be beneficial, if painful, for the market if it eventually becomes the pause that refreshes. In an ideal world, we reset the clocks, end this game of internal rotation by washing everything out, value and defensive too, and get back to the bull market, Kolovos says. Sounds like a plan. Chaos rules the market, and Wall Street's analysts haven't helped navigate the wild twists and turns, even with plenty of opportunities available. Despite the recent volatility, 98 stocks in the S&P 500 index had gained 10% or more through Wednesday's close, while just 43 had suffered double-digit declines, suggesting there's room for stock pickers to add value if they pick the right stocks. Big winners include Supermicro Computer, CVS Health, and Tapestry, while the biggest losers included Edison International, West Pharmaceutical Services, and Deckers Outdoor. Analysts weren't fans of the biggest losers. The percentage of buy ratings on the 43 names was 46.6%, according to FactSet data. That's below the average stock's 55%. Unfortunately, the average percentage of buy ratings on the biggest winners was only 47.2%. What's more, the two biggest losers, Edison and West Pharmaceutical, had 55% and 67% buy ratings respectively, while the biggest winner, Supermicro, had just 30%, and CVS, which came in number 2, had 55%. That's par for the course. Trivariate Research's Adam Parker notes that the stocks most loved by Wall Street analysts have underperformed those they hate by 30 percentage points since 2001, with periods of sharp underperformance followed by outperformance before reversing. Upgrades and downgrades produce large one-day moves, but improvement in ratings doesn't translate into better performance. It goes on. Stocks with the biggest gaps between their current prices and their average price target outperformed from 2009 through 2016, but these days it's more likely to be a sign that analysts were bullish on a stock that went on to drop. Analysts also tend to have more buy ratings on high beta stocks, the market's most volatile, which can come back to bite investors during periods of risk-off trading. The signal that appeared to lead to outperformance when analysts have priced targets in the same ballpark has even begun to work less well, according to Parker's data. And as he writes, a signal that's cumulatively ineffective and volatile is not a signal investors should use for stock selection. But maybe we're thinking about the problem all wrong. Personally, I love analyst reports. In my previous life as a trader, I made money playing the swings produced by upgrades and downgrades, and as a journalist, analyst reports are essential for keeping up with what's happening in individual stocks and helping me spot new concerns or catalysts. It's always worth paying attention when an analyst breaks from the herd. I remember J.P. Morgan's Stephen Tusa becoming the first sell-rated analyst on General Electric, long before investors caught on to just how bad things had gotten at the once dominant industrial giant. It's also beneficial to think about what analysts have gotten wrong. Take Microsoft, a stock that Wall Street simply loves. Its shares fell 2% over the past 12 months, making it the worst performer among the Magnificent Seven stocks in the period. That's probably not what analysts had in mind when 94% of the 57 covering it at the end of March of 2024 rated shares a buy, with an average price target of $472.62. The subpar performance hasn't dampened the enthusiasm for Microsoft, at least not by much. As of Wednesday's close, 93% of the 58 analysts covering the stock still rated it a buy, with an average target price of $510.22. up 28% from a recent $399.73. Analysts had been expecting Microsoft's tie-up with OpenAI to give it a leg up in artificial intelligence, while the rush into AI would increase demand for its cloud business. Instead, AI has increased costs. Microsoft's capital spending rose 58% to $44.5 billion in 2024, while revenue from Azure, the company's cloud business, came in at the low end of guidance. But analysts pointed out that the problem in the cloud had little to do with AI, while Microsoft also offered a better-than-expected margin forecast. Analysts naturally still love the stock. BofA Securities' Brad Sills, for instance, calls Microsoft a rare winner. If the company can execute better, the demand for AI in the cloud should help it get back to a more consistent beat-and-raise pattern. This year, Sills writes, we continue to believe that Microsoft remains uniquely positioned to monetize the vast new AI opportunity across applications and infrastructure at scale. It's an interesting idea, one that looks more compelling with the stock trading near the bottom of the range than it has been stuck in for the past year. Unlike other members of the Mag 7, it doesn't have big gains to give back, and the stock at 27.8 times 12-month forward earnings is near the bottom of its price-to-earnings range over the past 5 years. Since Microsoft is range-bound, a stop-loss order at, say, $385 would allow you to exit with a minimal loss if support breaks. Give the analysts a break. Ultimately, it isn't about the research, it's what you do with it. The next column is Streetwise. Latest from Big Food: peak protein, anemic algo, and weird ideas. This is written by Jack Huff. If you find slide presentations about packaged food exciting, there's nothing like February to Orville your Redenbacher and Duncan your Heinz. Each year, the likes of Kraft Heinz, General Mills, and Conagra brands spend a week with the Consumer Analyst Group of New York. In Florida, naturally, this year's CAGNY conference moved from Boca Raton to Disney World, which isn't quite as winterproof, but is more inspirational when it comes to overcharging for overeating. Big Food could use some fresh ideas. While the broad U.S. stock market is up smartly over the past year, shares of the aforementioned companies have declined, along with J.M. Smucker, Mondelez International, Hershey, and PepsiCo. Lingering inflation is pinching family budgets. Eggs are so expensive in my suburban town that backyard chicken coop owners are swaggering like Bitcoin billionaires. Consumer confidence dropped sharply in February, says the conference board. Wall Street's worried about trade wars, and obesity drugs are a looming threat to the long-term cookie monsterization of consumer eating habits. Meanwhile, spice seller McCormick is up 20% in a year. We don't compete for calories, we flavor them, its CEO boasted in an earnings report that showed strength in seasonings, recipe mixes, mustards, hot sauces, pretty much everything but sales of flavorings to fast food restaurants. What kind of post-snack-apocalyptic hellscape are we living in, where families are gathering together over fragrant roasts? The most important part of CAGNY isn't the slide presentations. It's when analysts return to frigid New York and publish bar charts and bullet points about the presentations and the broad themes that emerged. J.P. Morgan took a data-driven approach this year, counting topic mentions and comparing with past years. On the rise versus last year were consumer sentiment, inflation, and cash flow. Falling were sustainability and emerging markets. Value hit an 8-year high and premiumization an 8-year low. Rising in mentions for each of the past 7 years was elasticity, presumably a reference to demand and not pants. Mentions of snacks also hit an 8-year CAGNY low, which is like space not coming up much at Trek to Vegas 2025. JPM points out that snacks have been in a deep slump for over a year. General Mills, the cereal giant that also owns Bugles and Chex Mix, barely mentions snacks. Conagra bucked the trend and talked plenty on the subject. Snack occasions, it said, are up. especially for kids and teens, and now outnumber meals, with more consumers engaging in mealtime snackification. It's just that demand is shifting from chips and cookies to categories like meat snacks and nuts, it said. Did I mention that Conagra owns Slim Jim and David Sunflower Seeds? Innovation's back. The subject dipped during COVID when supply chains were crimped, and then it rebounded the past few years as food makers searched for growth. But are we pushing boundaries too far? J.M. Smucker discussed the humanization of family pets and presented Milk-Bone peanut buttery bites made with real Jif. It called it the first dog treat featuring a human food brand, and part of its strategy of expanding consumption through impulse across innovation and activation. My kids have been sneaking dinner scraps to the dogs for years, and I never thought of applauding their humanization impulse activation. Conagra has noticed that consumers who take GLP-1 drugs for obesity tend to buy more frozen foods, so it's adorning boxes for some of its healthy choice meals with the words GLP-1 friendly. That seems sensible. On the other hand, I'm taking a wait-and-see and don't-eat approach to Conagra's new frozen Vlasic Big Crunch crispy fried pickles. B of A Securities asks in a report whether we're hitting peak protein. It means product proliferation, but it could be just as easily talking about font size. To my eye, General Mills is using larger and more muscular can lettering for 24-gram protein, capital letters, than for Progresso and Mediterranean-style lentil. The same goes for boxes of strawberry Cheerios protein, which trumpet 8 grams of the macronutrient and whisper 12 grams of sugar. W.K. Kellogg stressed how we can expand beyond cereal, including through inorganic growth or acquisitions. Oopsie. Recall that Kellogg split in 2023, leaving W.K. Kellogg with North American cereal and Kellanova with snacks, frozen food, and international cereal. You can read all about it in that year's W.K. Kellogg Investor Day presentation, slide 5, which has only 9 words. Everything we do will be in service of cereal. Not great. If big food sounds like it's stretching, blame algorithms, the term Wall Street insists on using to discuss the group's growth. I think it's to evoke steadiness. Consumer staples are supposed to provide small but dependable revenue gains, resulting in moderate earnings growth and respectable stock returns, including dividends. Well, that's mostly not happening now. This year and next could be below algo for General Mills, according to B of A. Kraft Heinz will have no algo until 27. Hershey, hit by high cocoa prices, could get back to on algorithm, but it will take until next year, and so on and so on. Oppenheimer sums up the outlook given inflation, limited pricing power, obesity drugs, tariff risks, and private label encroachment. A difficult backdrop is likely to continue. Investors should keep that in mind as talk swirls once again about a U.S. market rotation into value stocks, including staples. The cheap ones don't look growthy, and the growthy ones don't look cheap. General Mills at 14 times earnings is expected to post a modest earnings decline for its fiscal year ending May. McCormick, growing at mid-single-digit percentages, goes for a peppery 25 times earnings. For next year's CAGNY, if things haven't improved, does Chris Stapleton do corporate gigs, and would he be willing to tweak his mournful "I've seen my share of broken halos" to refer instead to algos? Just brainstorming. I also have an idea for kibble and Slim Jims. We'll move on to the review and preview section. Tesla. How far is down? While Elon Musk presides over his chaotic restructuring of the U.S. government, Tesla investors are trying to get their bearings. On Tuesday, shares plummeted 8.4% after disappointing sales data from Europe fed the belief that Musk's political activities were hurting demand. Tesla sold only 9,900 cars in January in Europe, down 45% from the prior January, even as European electric vehicle sales rose 37%. Tesla's market cap fell below $1 trillion. That was just the latest shock. The stock's down 37% from its record closing high of $480 on December 17th, shedding $570 billion in market value. And it's off 29% since Donald Trump's January 20th inauguration. It's cost Musk some $140 billion in net worth. The good news is relative. Shares are up 27% since the company's October 10th robo-taxi day, when Tesla talked up plans for a self-driving taxi in 2025. Hopes were fueled by the belief that Trump would speed U.S. self-driving efforts. Fairlead Strategies market technician Will Tamplin said Tesla stock had support at about $315, which the stock breached on Tuesday. Tamplin isn't making a fundamental call. He's looking at charts to see when investors have bought and sold. Support represents where investors have bought stock. Falling below support suggests investors' thinking has changed. Capthesis founder Frank Capillari notes additional support for Tesla at $275, near the stock's 200-day moving average. The stock closed on Friday at $293, and that was reported by Al Rote. Last week, in our review and preview section, markets. Germany's Christian Democrats, led by Friedrich Merz, won federal elections. Coalition talks began on Friday. The U.S. supported Russia on a United Nations resolution vote on Ukraine. President Trump threatened tariffs on China and Europe and said levies on Mexico and Canada would begin on March 4th. U.S. stocks and crypto sold off, with the S&P 500 index 4.6% off its February 19th high on Thursday. On the week, the Dow Industrials rose 0.95%. The S&P lost 0.98%, and the Nasdaq Composite fell 3.47%. In companies last week, Berkshire Hathaway's cash pile grew to $334 billion in 2024 from $168 billion the prior year. Companies are raising prices in anticipation of 25% steel and aluminum tariffs. Apple said it would spend $500 billion in the U.S. to build its artificial intelligence business. A TD Cowen report suggested that Microsoft was canceling leases on AI capacity, a cautionary move. NVIDIA beat on sales and earnings, but investors were lukewarm. Supermicrocomputer shares soared, then fell after the company filed delayed financials. In deals last week, Ukraine President Zelensky left the White House without signing a deal to monetize mineral assets in Ukraine. Sun Communities agreed to sell 100% of its Safe Harbor Marinas business to Blackstone for $5.65 billion, all in cash. The founding family of Japan's Seven & I Holdings failed to get financing to buy the 7-Eleven owner. Waiting in the wings with a $47 billion bid, Canada's Alimentation Couche-Tard. And this week, from the review and preview section, Monday, the Institute for Supply Management releases both its manufacturing and services purchasing managers' indexes for February. Consensus estimates are for a 50.5 reading for the manufacturing PMI, which will be released Monday, and a 53 reading for the services PMI to be released on Wednesday. This compares with readings for 50.9 and 52.8, respectively, in January. On Tuesday, March 4th, more than 95% of the companies in the S&P 500 index have reported fourth quarter results, with roughly three-quarters beating earnings per share estimates and about 60% surpassing sales projections. On tap this week are CrowdStrike Holdings and Target, which announced results on Tuesday. Two mega-cap companies, Broadcom and Costco Wholesale, released their earnings on Thursday. Friday this week, the Bureau of Labor Statistics releases the jobs report for February. Economists forecast a 155,000 increase in non-farm payrolls after a 143,000 gain in January. The unemployment rate is expected to remain unchanged at 4%. Initial jobless claims have risen recently, adding to investors' fears of a growth scare that has shaved 3.1% off the S&P 500 since its record close on February 19th. The numbers: 49.7%. That's the percentage of consumer spending by the top 10% of U.S. earners. That's a record high going back to 1989. 27%. The rise of the number of Fidelity 401k accounts of $1 million or more, ending 2024 at 537,000. 7. How much the Conference Board Consumer Confidence Index fell in February, the largest since August of 2021. 52%. The percentage of U.S. workers worried about the use of AI in the workplace. Some 16% say it's already there. The next headline in the issue of March 4th, Barrons magazine: the gold rally is roaring. How to play it now. The precious metal, long considered an inflation hedge, has more than doubled the S&P 500 index's return over the past year. Is long lagging silver next? By Brian Swint. Gold's stellar run is too shiny to ignore, and its rally could continue through 2025. The precious metal is certainly having a moment. On February 24th, President Donald Trump said he was worried that someone might have stolen gold from Fort Knox, the U.S. depository in Kentucky. Worries that he might place tariffs on gold have created a flurry of activity as bars in London, where the Bank of England is home to the world's second biggest stockpile, have been transported to New York, where the Federal Reserve has the largest reserves. There's even speculation that the U.S. could revalue its gold holdings to give the Treasury $750 billion more to play with. All told, gold futures have reached $2,925.10 an ounce, returning 42% over the past 12 months, more than double the S&P 500 index's 19% return, including reinvested dividends. That's not bad for a commodity that has little practical use and doesn't produce earnings or pay interest to those that hold it. What's more, the reasons offered for gold's rally are often contradictory and don't seem to hold up when investigated. It's considered a defensive asset, but has been rising along with the stock market and as the economy chugs along. The precious metal, which is priced in dollars, should move in the opposite direction of the greenback, but it's bucked that rule as well. Gold is often thought of as an inflation hedge, but its big gain has coincided with a deceleration of price increases. Yet just because everything we thought we knew about gold is wrong, doesn't mean that investors should be rushing to unload the metal. It's just a pet rock, but I'm not selling it, says David Jane, a portfolio manager of Premier Milton in London, which has about 5% of the $1 billion he manages allocated to gold. You can't pin down its price. I'm not going to cut and run. Historically, gold has been considered a store of value, and for good reason. There's a limited supply. All of the gold in the world could be melted into a cube measuring 25 yards on each side, roughly the volume of one floor of an office building, and miners are able to increase it only by 1 to 2% a year, despite their best efforts, according to the World Gold Council. If supply is relatively fixed, then changes in price are all about demand, and demand has picked up. Central banks across the world have been consistently increasing gold purchases as a way to diversify their reserves. De-dollarization isn't new, but it's taken on considerable urgency after the U.S. froze Russia's assets in the wake of its invasion of Ukraine. Central bank purchases exceeded 1,000 tons for a third year in a row in 2024, according to the World Gold Council. China and India in particular snapped up gold over the past few years. Central banks can't entirely ignore the prices they pay for gold, but as the value of their holdings rise, it means they feel more comfortable stepping in to buy more, says Philip Newman, a founding partner of the Metals Focus Consultancy, especially when prices declined. Gold has a floor level of support that is strong and rising, he explains. There's a decent level of retail demand for gold the world over. Spending on jewelry rose 9% last year, according to the World Gold Council. China has even encouraged insurance funds to stock up on the metal, and ordinary households in the world's second biggest economy may be looking to gold after the nation's spectacular property crash during the COVID-19 pandemic. Others may be rushing to buy it simply because the uncertainty created by Trump's shakeup of the world order could be helping gold, even if stocks and the economy are booming too. Gold plays well when there are tensions in the world, says Krishan Gopal, an analyst at the World Gold Council. Other factors may also be contributing. The sharp rise in gold prices, the anticipation that the U.S. will levy taxes on gold imports in the near future pushed up the cost of physically delivering gold, which in turn pushed up prices for borrowing it. This created a kind of short squeeze in which everyone who had bet on gold prices falling suddenly had to reverse their positions, driving prices even higher, according to Gavekal research. This means that the fundamentals of the gold bull market are still strong and the technicals are rock solid, writes Gavekal's Louis Vincent Gave. Gold may also be benefiting from people having too much money to put to work, says Premier Mitons Jane, creating momentum that just won't quit. The positive correlation between gold and equities suggests to me that it's excess liquidity around that world that's getting sucked into gold, just like it's going into large cap U.S. stocks and anything else that looks like fun at the moment. Jane says, this is speculation, not fear. The momentum should continue. While $3,000 could be an important psychological level, many analysts see the metal moving even higher. In February, Goldman Sachs and UBS raised their forecast for 2025 to $3,100 and $3,200 respectively, while Bank of America's Michael Widmer says gold could hit $3,500 an ounce if investment demand increases by 10%. That's a lot, but not impossible, he writes. Worldwide, gold-backed exchange-traded funds attracted $3 billion in January, driven by demand from Europe, according to the World Gold Council, compared with net outflows a year earlier. Buying gold can be very simple, as easy as heading to your local Costco or Walmart and buying a bar or coin. Those slices of gold are more souvenirs than serious investments, however, and selling them could be difficult. A better option could be to buy shares of gold exchange-traded funds, such as the $85 billion SPDR gold shares, which has an expense ratio of 0.4%, or the $38 billion iShares Gold Trust, which charges 0.25%. Mining stocks are another way in. Even though their earnings should increase more or less in line with higher gold prices, their share prices lagged behind the metal itself over the past 3 years. That means they could be due for some catch-up. The $14 billion Van Eck Gold Miners ETF, which owns big global miners Newmont and Barrick Gold and has an expense ratio of 0.51%, has returned 19% this year, including reinvested dividends, compared with 11% for the SPDR Gold ETF, while the $5 billion Van Eck Junior Gold Miners ETF, which charges 0.52%, has returned 17%. Among individual miners, Gold Fields, which operates in Australia, Ghana, Peru, and South Africa, is up 44% this year and could be poised to break out of a 30-year trading range, according to the Institutional View's Andrew Addison. Don't want to miss this because GFI boasts the biggest base of any gold stock, he writes, while recommending that investors buy shares on pullbacks to $18 from a recent $19 in anticipation of a move above $20. For those concerned that gold could lose momentum after its rally, silver might be the way to go. The two metals often trade similarly to each other, even though silver has more industrial uses than gold. But that extra use case is what has been keeping silver down, due to a slump in demand from the slowdown in Chinese manufacturing. Silver futures are up just 6.8% this year, compared with gold's 10% rise, and could have more room to run if investors start getting more comfortable with the economy. Investors could consider the $14 billion iShares Silver Trust ETF, which has an expense ratio of 0.5%. Investors aren't focused on silver, says Newman at Metals Focus, but if gold gets to $3,000, you could see some switching. For now, though, gold is as good as, well, gold. Our next article in this week's Barrons magazine has a headline that reads, "The PayPal Mafia Hits D.C., a guide to Silicon Valley's hostile takeover." As Elon Musk dominates Washington, another wave of tech experts is still to come. They'll influence policy on crypto, healthcare, China, and more. This is written by Jacob Edelman. A cryptocurrency promoter is set to helm the nation's commodities regulator. An online payment entrepreneur has been nominated to lead its space program. An electric car, aerospace, and social media mogul, the world's richest person, is overseeing the dismantling of long-established federal agencies. An unprecedented number of figures from a single industry, technology, are assuming posts in the Trump administration. They're already leaving a deeper mark on Washington than past business power centers, military, banking, and energy, whose executives have frequently assumed cabinet posts. The most scrutiny so far has fallen on Elon Musk and his Department of Government Efficiency, or DOGE, which wields broad authority over federal spending and workforce reductions. Yet to come is a wave of appointments that will influence policy in areas ranging from cryptocurrencies to healthcare to competition with China. What we see now isn't different in kind from what we've seen before, says University of Texas at Austin history professor Henry Barrons, but it's different in degree. A common denominator among many of these figures is their links to Musk and venture capitalist Peter Thiel, who, along with newly appointed crypto and artificial intelligence czar David Sachs, are members of the Silicon Valley clique known as the PayPal Mafia, entrepreneurs who found some of their earliest riches developing the payment portal. Others are in the overlapping orbit of tech investor Mark Andreessen. Thiel and Sachs are stalwart political conservatives, long an anomaly in Silicon Valley. Musk and Andreessen swung to the right more recently and perceived slights by the Biden administration which they saw as overly meddlesome. The seeming unfriendliness of Biden toward Silicon Valley has been an important driver of why there's been such an enthusiastic embrace of Trump by some of these tech investors and entrepreneurs, says University of Washington history professor Margaret O'Mara, author of The Code, Silicon Valley and the Remaking of America. This clique's worldview is shaped by their staggering Silicon Valley ascents. They revere personal achievement and see their own success as a mandate to lead. They scorn regulation, convinced that it stifles progress, not just for business, but for humanity itself. They move fast and break things, confident they're clearing the way for something better. They share the broader MAGA skepticism toward diversity, equity, and inclusion policies, which they see as elevating people based on criteria other than merit. They sympathize with advocates of strong borders up to a point. Their businesses rely on highly skilled foreign workers. Finally, they're very rich, so they presumably aren't in it for the government paycheck, which in some instances is being waived. Rather, the postings offer an opportunity to make a mark on society, while tilting policy to benefit their business niches. They believe they have lots of answers, says Peter Capelli, who's examined startups as a management professor at the University of Pennsylvania's Wharton School. You might call it unbridled optimism, or you might call it real overconfidence. Their impact is already being felt, largely because of DOGE, the ad hoc department led by executives on loan from Tesla, SpaceX, and X, formerly Twitter. Trump has empowered it to take drastic steps in the name of boosting efficiency and fighting waste, fraud, and abuse of taxpayer resources. DOGE has sought has sought access to vast troves of financial records maintained by the U.S. Treasury and other agencies, and was instrumental in freezing funding for the U.S. Agency for International Development. Thousands have been laid off at Doge's behest, though some of its efforts remain stymied by court challenges. On its website, Doge credits itself with $65 billion in savings through detecting fraud, canceling or renegotiating leases and contracts, layoffs, and other efforts, though an analysis by the Wall Street Journal suggests the savings figures may be overstated. Even those with few direct ties to Musk come steeped in the same Silicon Valley culture that values questioning norms and unfettering technology. Some see in this worldview a lack of consciousness of the negative consequences of moving fast and breaking things on a governmental scale, where the stakes are higher than at a corporate level. Smashing things up fast with a view to possibly rebuilding later is fine if you're running a private company and the rest of society doesn't depend on you, says Sebastian Mallaby, author of The Power Law, Venture Capital and the Making of the New Future, referring to Musk's Doge efforts. The one thing that seems to elude him is that he's not a good idea to apply the same move fast, break things disruption strategy to government as you do in the private sector, Mallaby says. There are also inherent conflicts. Democrats worry that Musk could leverage his government role to steer lucrative contracts towards SpaceX. Other appointees and nominees have ties to Thiel-linked military firms that stand to gain from heightened tensions with foreign adversaries, such as China. They presumably believe that if they have Trump's ear, if they're there when the sausage is being made, they'll have a chance to influence the product, says historian Barrons. Most of Musk's lieutenants at Doge are executives from his past companies. They include Boring Company executives Steve Davis and Riccardo Biasini, along with SpaceX human resources official Brian Bejeldy, according to a fact-finding letter from Senate Democrats. Musk associates are also among those taking more formal roles. Thomas Shedd, a Tesla software engineer, is now serving as a deputy at the General Services Administration, overseeing technological modernization, and digital payment billionaire Jared Isaacman, founder of Shift4, has been nominated to lead the National Aeronautics and Space Administration after commanding 2 SpaceX missions. Another faction is tied to tech investor Andreessen, co-founder of venture capital giant Andreessen Horowitz. Scott Kupor, managing partner at Andreessen Horowitz, has been nominated to lead the Office of Personnel Management, and Brian Quintez, head of crypto policy at Andreessen's firm, is seeking confirmation to chair the Commodity Futures Trading Commission, where he previously served as a commissioner during Trump's first administration. Another incoming official, Sriram Krishnan, is the Andreessen Horowitz partner, who faced backlash from Trump supporters over his previous advocacy of expanding high-skilled immigration caps after he was appointed to advise on AI policy with Sachs. The other contingent is connected to Thiel, a longtime Silicon Valley conservative who was one of the first in the sector to publicly back Trump in 2016. His firm has invested alongside Andreessen's in one-time startups, including Meta platforms Facebook, Airbnb, and Lyft. That group includes Jacob Hellborg, a former senior advisor at Palantir Technologies, the data analytics company co-founded by Thiel, who has been nominated to a role overseeing economic and energy policy at the State Department, and Michael Kratsios, a former Thiel Capital executive who served in high-level roles at the Department of Defense during Trump's first term and has been tapped to direct the White House Office on Science and Technology Policy in his second. Medical technology executive Jim O'Neill, a co-founder of Thiel's fellowship program, which supports entrepreneurs who drop out of college, has been nominated as Deputy Health and Human Services Secretary. O'Neill also served as managing director at Mithril Capital Management, a firm co-founded by Thiel, where Vice President J.D. Vance got his start in venture capital. These are people who have done business with one another, says University of Washington's O'Mara. They're kind of the PayPal mafia writ large. The next headline: beaten up Yeti stock looks like a buy. Known for its rugged travel mugs, Yeti is expanding with new products like backpacks and luggage, and that stock could deliver solid upside. By Ian Salisbury. When it comes to Yeti Holdings, investors see the water bottle as half empty. A better bet? Take a swig of the stock, which actually looks half full. Founded in Austin, Texas by two outdoor-loving brothers, Yeti built a brand around adventure and ruggedness, selling $40 insulated mugs and $800 stainless steel coolers. The company went public in 2018 and surged during the pandemic as hiking and glamping took off. By late 2021, shares had zoomed past $100 from an initial offering price of $18. Today, the glam's gone. Yeti stock has been stuck in the 30s. Competitors like Stanley and Owala started their own water bottle fads. Earnings growth has slowed, and now there's a tariff threat. Yeti has historically manufactured its mugs and other drinkware in China, and those imports were recently hit with 10% tariffs by President Donald Trump. The stock dropped 39% over the past 3 years. Yet the market is missing Yeti's strength. Sales, while slowing in recent years, should start to pick up with new product lines, overseas expansions, and a lift from investments in a promising category, backpacks and luggage. The tariff threat looks manageable, and the stock's valuation isn't demanding at 12.2 times 2025 consensus earnings estimates. At some point, the market's going to realize the stock's way too cheap for what it is, says Jefferies analyst Randall Koenig, who sees the shares reaching $55 within a year, up from a recent $35. There's nothing wrong with Yeti's financials. Wall Street expects sales of $1.95 billion this year, up 6.5% from 2024. Earnings growth is expected at 7% this year and 8.5% in 2026. Putting earnings per share at $3.17, up from an estimated $2.92 for 2025. Yeti's backbone, drinkware, at about $1 billion in 2024 sales, is expected to grow 4.6% this year. Its coolers and equipment line, estimated at $754 million in sales for 2025, is expected to be up 8% this year. Not everything's perfect. On its fourth quarter earnings call, February 13th, the company says it sees signs of more promotional activity and heightened competition, particularly in the U.S. market. Canaccord Genuity analyst Brian McNamara points out that 50% of Dick's Sporting Goods stores reported Stanley as their best-selling brand over the holidays, followed by 41% for Owala and 9% for Yeti. Owala appears to be this year's Stanley, while Yeti fades into the background in drinkware, he writes. CEO Matthew Rinches dismissed the notion that Yeti's falling behind, saying it's focused less on fashion and more on getting its products into the hands of athletes through partnerships with schools and teams like the Kansas City Current in women's soccer. We expect drinkware to be a growth driver in all our markets, he told Barrons. The data back him up. Global travel mug sales are expected to double to $26 billion by 2033. That's according to market research from iMark, suggesting there's room for multiple brands in the space. Yeti, meanwhile, has expanded overseas, where sales grew more than 30% to just under $340 million in 2024. While Yeti doesn't break out sales by country, Canada and Australia are its most established markets. On its recent earnings call, executives said that the company has been expanding steadily in the UK and Germany. In January, Yeti held a Tokyo event to introduce its products to Japan. International markets are a big opportunity, says Austin Bone, portfolio manager of the Wasatch Small Cap Value Fund, which owns the stock. There are similar brands that have a 40 to 50% revenue contribution from international, he says, compared with about 20% for Yeti. The biggest new product area for Yeti might be luggage. The company now owns Mystery Ranch, a backpack maker with a small but dedicated following among firefighters and military personnel. In December, a limited edition Yeti backpack based on a Mystery Ranch design quickly sold out. There's a real opportunity for the brand to expand without going too far outside what they're known for, argues William Blair analyst Philip Blee. Yeti's strong balance sheet, it had $281 million in net cash at the end of last year, should give it flexibility to invest in new markets while handing profits back to shareholders. The company carries minimal debt and boasts pre-tax operating margins that are holding steady at nearly 17%. Buybacks could also nudge up earnings per share. Yeti's board has approved up to $450 million in buybacks after repurchasing $200 million of shares in 2024. At a $200 million annual clip, Yeti would buy back a third of its current market value of $3 billion over the next 5 years, assuming its stock price holds steady and there's no additional share issuance. Even without those buybacks, Blee expects earnings to hit $3.25 a share in 2026, slightly above Wall Street's average target. At 15 times earnings, that would put the stock at $49, up 37%. Tariffs may not be the problem they're made out to be. Yeti began moving drinkware production out of China in 2023, and it expects 80% of U.S. production capacity to be outside of China by the end of 2025. The 10% Chinese tariffs will add just $10 million to Yeti's costs in 2025. That's according to Chief Financial Officer Mike McMullen. Reinches expressed optimism that the company will manage through it. It's a little bit of a moving unknown, he said. We're more focused on making sure that we position our supply chain in places that we think meet the business strategy, and then we'll manage the tariff exposure in that business. Yeti isn't the leaky, beaten-up bottle the market considers it to be. Its coolers and drinkware can survive some hard knocks, and the stock can too. And the cover story on this week's Barrons, dated March 3rd of 2025. My apologies, I believe I've been referring to it as March 4th, Monday, March 4th, but it isn't. It's Monday, March 3rd. And that's the issue date that we are reading of Barron's magazine. And the headline of the cover story, Chinese stocks are beating U.S. stocks. How to spot bargains. China's problems extend beyond tariffs, but some see fresh reasons to return to a market that they once shunned, by Reshma Kapadia. Investors have had plenty of reasons to give up on Chinese stocks in recent years. China's economy is muddling through a rout in the property market that's dented consumer balance sheets and left households skittish to spend. Debt and an aging population dampen longer-term growth prospects. Foreign direct investment plummeted 99% over the past 3 years as companies reassessed their China exposure, and China leader Xi Jinping's multi-year corruption and private sector crackdown damaged business confidence. Adding to all of the uncertainties, the threat of sky-high tariffs and a trade war with the U.S. In emerging markets, sometimes the biggest gains come when things go from horrible to a little less so. The MSCI China Index is up 18% this year, making it one of the better performing markets globally and far outpacing the S&P 500 Index's 2% gain. Some of the worst case scenarios are fading, forcing a rethink even among bears like Morgan Stanley's China equity strategists, who in mid-February shifted from deeply skeptical to cautiously more optimistic, upgrading their stance on China stocks to equal weight versus the benchmark. At the beginning of the year, investors worried that China could get hit with 60% tariffs on imports and be the Trump administration's main trade target. But the early tariff salvos have been tamer than feared, fueling expectations that the U.S. and China could spend the coming months in the art of deal-making instead of skirmishing. That and fresh efforts by Chinese officials to backstop the economy have sparked a dose of optimism in a country that many thought was uninvestable just a few months ago. Instead of shunning Chinese markets, investors are now searching for bargains. Since the fall, Beijing has started to course-correct its approach to healing the economy, unveiling monetary and fiscal measures to put a floor under the economy and domestic market. The latest pivot came as Xi met with the country's top technology leaders, including heads of artificial intelligence and electric vehicle companies and leaders of internet giants that had been in the regulatory doghouse for years. The reappearance of Jack Ma, Alibaba Group Holdings' once outspoken co-founder, who became persona non grata after taking regulators to task in 2020, signaled that the technology sector may be back in favor and Beijing now more willing to support entrepreneurs. After the meeting, an official with the country's top economic planner said it would further reduce investment barriers and improve private enterprises' market access. The developments bring renewed attention to what's still one of the cheaper corners of the global market. The MSCI China trades at 12 times next 12 months' earnings, compared with 22 for the S&P 500. For Binayat Kotari, who manages $1.2 billion at hedge fund Techne Capital Management, the setup for China is better than it's been in 2 years, and the bullish case goes beyond prices and possible government stimulus. The U.S. and China are still locked in an escalating economic and military rivalry, and the rapid-fire policies of the Trump administration and China's responses ensure near-term volatility. Plus, Chinese rallies have fizzled several times as Beijing has failed to deliver on its strong verbal support. Another year of underwhelming stimulus that fails to heal the property sector and revive confidence could be a spoiler. But on the geopolitical front, investors are taking comfort that China isn't the sole target of the Trump administration. Early tariffs were directed at allies like Canada and Mexico, and plans for reciprocal tariffs, matching the duties and other barriers that countries levy on U.S. trade, could also hit Europe and India. While the U.S. imposed 10% tariffs on Chinese imports and threatened on Thursday an additional 10% increase effective March 4th, President Donald Trump punted on other measures, directing his team to assess the China relationship and its compliance with the Phase 1 trade deal that was struck in Trump's first term. The administration also reversed course after initially suspending duty-free treatment of goods valued at under $800 that's allowed Chinese retailing giants Temu and Shein to flourish. The White House didn't respond to requests for comment. This past weekend, the White House released a memo outlining its America First investment policy. It describes China as an adversary and outlines a way to promote foreign investment while bolstering national loopholes that have allowed security. Among them, limits on Chinese investments in strategic sectors in the U.S. and restrictions on U.S. investments in Chinese semiconductors, biotech, and AI that could be aiding China's military. But many of these proposals had already been working their way through Congress and the Biden administration, and investment in both directions has already cooled. Kevin Carter, Chief Investment Officer of emerging markets-focused EMQQ Global, described the memo as a simple chess move and a grander plan for a China-U.S. master deal. Like other investors, Carter sees Trump's repeated remarks about his great relationship with Xi Jinping and hopes to meet with him in his first 100 days as a positive for the relationship. Analysts do see glimmers of improvement. Autonomous Research senior analyst Charlene Chu expects Beijing to support Vanke, which the market has taken as a positive. Property sales have picked up with recent stimulus efforts, and some of the biggest cities are seeing prices stabilize. One positive, people expect the magnitude of property price declines to moderate this year. The next signal will come from meetings that start on March 4th when China's top policymakers unveil the fiscal budget and growth projections for the year. Also expected are details on measures they've talked about in recent months, including more government bond issuances and potentially more fiscal stimulus, such as expanding trade-in programs to spur the buying of appliances and industrial equipment. Beijing's likely to reserve some of its fiscal stimulus. The economy has gotten a boost in recent months from strong export demand as companies pre-buy ahead of potential tariffs, and officials want to get a better handle on U.S. policy before unleashing their firepower. And with that, we've come to the end of our reading of Barrons magazine for Monday, March 3rd of 2025. This is your reader, Eric, saying be well, be safe, look after each other. Remember our veterans, especially those we've lost recently. Bye for now.